Wealthy and Wise is your guide to value investing, powered by Teaminvest.
A very warm welcome to Wealthy and Wise. And we're looking forward to this week's episode because, of course, share prices move day by day. But what really drives returns? Is it the underlying earnings of a business or the market's changing sentiment? Well, today we break down the relationships between earnings, sentiment, and returns, and what it means for investors trying to build long-term wealth. We will compare and contrast some stocks and give you a look at Teaminvest's conscious investor platform in real time. Plus, we will answer a viewer question. So let's start by adding some value. Well, every share price comes down to two things: the performance of the business and how the market chooses to value it. So in this segment, we break down that relationship, earnings versus sentiment, why one is predictable, the other isn't, and how understanding the gap between the two can create opportunity. So let's make sense of it all and find out where the value lies with Andrew Coleman and Sanjeev Narendran from Teaminvest. Guys, welcome to the program. Great to have you as always. Andrew, you break the price of a stock into two parts, earnings and sentiment. So why is that so important?
Well, I think let's start with the fact that it's a simple accounting identity, right? The price of an asset is known, and we talk about this all the time, to be broken down into two parts: an objective component and its subjective component. And the maths is pretty simple. You can use the expression price is earnings per share times the PE ratio. And of course, anyone with a bit of a mathematical breakdown just realizes the E cancels out, and so price equals price, right? I think why it's so valuable, though, as a framework beyond just a simple accounting identity is that it enables you as an investor to look at those two parts separately rather than having the noise of the market cloud the two. So, of course, the earnings per share of a company are objective. We can tell that very easily. All we have to do is go to an annual report, find out how the business has been performing, and put down that information. The challenge then becomes, of course, is that price is driven in the end by the humans or machines, as it may be today, in the market trading that. It's a simple auction, buy and sell. And so the challenge you have as a long-term investor, or any investor for that matter, is trying to work out what's going to happen to price over your investment horizon when one of those elements is constant or known, earnings, and the other is very unstable and unpredictable.
Yeah. Okay, so let's start with earnings. What are the key things you need to know to forecast them properly?
Well, to make any sort of prediction, you want to make a prediction on something that's stable. So if you've got a company with stable earnings, then trying to forecast what it's going to be is going to be much, much easier and more accurate than trying to forecast something that is completely unpredictable. And it kind of goes true for everything, not just forecasting earnings. But if something's volatile and unpredictable, trying to work out, Benjamin Graham describes it as Mr. Markets as being the bipolar business partner that's constantly volatile. And the market as a whole probably is. But if you can find stability in that, then you know what you're dealing with, and you can kind of pick out those stable businesses to then make reliable predictions on.
What else do we need to know to forecast earnings properly?
Well, I think the past is usually the best predictor of the future. Certainly for stable companies. Sanjay touched on a point there, and we've talked about it in previous episodes, but being an analyst covering the entire market is an incredibly tough job, right? Because you have some companies out there that are very stable, predictable, and easy to do. A CSL, you've got a pretty good view of what its earnings will be next year. Not only are they very transparent about that, but they've been following a very steady path for decades. On the other hand, something like NextDC, which is in a brand new market that's massively changing, the company's unlikely to know what its earnings are going to be 3 months from now, let alone a year or two. So being the analyst that has to cover them, or the investor that has to make a prediction in that case, life's going to be tough. But if you can confine your universe, as Sanjay said, to stable companies, then it's really easy. How's it grown in the past? Is there a risk that's triggered that means that growth is unlikely to continue? Or is it pretty much a good predictor? And again, you can do that through the process of elimination. If you're valuing Kodak in 1990, well, you knew a risk had triggered. The question was, how much were you going to assign to it? I would put that in my too hard basket. That's the joy you have as an investor. The analyst doesn't. The analyst still has to predict a number. The investor can say, no idea where that's going, and ignore it. But, stable companies tend to grow at the same rate year after year. That's their appeal. Now, of course, from a finance point of view, a finance theory point of view, it's also why you should never be able to get a bargain in a stable company, because everyone knows what it's growing at. The company's telling you what it's going to grow at, and the maths, therefore, is really simple. So why is it that they still throw up buckets?
Well, that comes down to sentiment, right? So why, I think it's obvious in some ways why sentiment is hard to predict, but break it down for us.
Well, I think at the end of the day, we're still monkeys. In a very nice way. I think most of us have looked better than perhaps an orangutan. But the idea, our brain is driven by fear and greed, and it's very short-term thinking. As humans, we oscillate between something being really good and something being terrifying. I think it was, actually, I can't remember who it was, but certainly Charlie Munger rephrased it very nicely. He said, most of man's ills come from the inability to sit still in a chair doing nothing. And it's true, right? When you look at global politics right now, most of our ills are coming because people can't sit still and do nothing. It's the same in investing. When we look at companies, or the market as a whole, it's very, very difficult for us to say, there's nothing new. It is what it used to be. There's nothing more to do here. And so as a result, our sentiment tends to swing wildly like a pendulum, from fear to greed and back in between. And that's that element of price that's really hard to predict. It's why the efficient markets hypothesis works and says that it's impossible to predict tomorrow's share price based on today's. The interesting thing about that, of course, and we've spoken on previous episodes, is over the long term, sentiment does get predictable. It does mean revert, because throughout the cycle, there are periods on every company where we will be greedy, periods on every company where we will be fearful, and a period in the middle where things will be neutral.
So, Sanjeev, how do moats play into all of this and the ability to forecast earnings going forward?
Well, moats are what make those companies stable. So having strong, deep moats that competitors can't penetrate allows that business to continue its earnings, continue its growth, and stop others from coming and eating market share from them. So the more a company has an established deep moat, the secure your investment is. And not only secure, you can forecast it better because it's now a stable business as opposed to something volatile without any moats protecting it.
Got it.
And that's the real secret sauce for an investor, right? If you can sit on your hands doing nothing and wait for when the market offers you a business that's highly predictable and stable with strong moats and risks that are unlikely to be damaging, at a PE, a sentiment that says the market's terrified, well, you know that over time the earnings will win and the market will eventually get greedy again and you'll make a lot of money. On the other hand, if you're out there, for example, as a short-term trader or a speculator trying to predict when that turn will happen, when will the market shift from greedy to fearful or fearful to greedy, good luck to you. There's probably 100 years of economic research that says you can't do it, but I'd love to see someone manage.
Well, we'll keep looking. All right. So how should investors then think about valuations? Bottom line.
Well, it's very simple, I think. Stick to the earnings, that's quantifiable, and then assume a long-term average PE that's either specific for that company, if you think that company has a unique reason, or just uses the market average. If you think that through the most of human history, or at least market history, the market has averaged a long-term PE ratio between 18 and 20 times, keep the math simple and throw 20 times into your model. What matters more is being able to predict those earnings, because in time, sentiment will swing back in each direction.
So less about what's the PE tomorrow, more about whether price and earnings have diverged in some way.
Absolutely. Well, if the earnings go up and the PE goes down, at some point that shift will change. On the other hand, if the earnings go down, at some point there'll be no business to apply the sentiment to.
All right. Well, look, we have talked about it. We've laid out the arguments to be made for it. Now we're going to talk specifics and we'll bring some stock names into it. And we will show you what the conscious investor platform that the Teaminvest team uses looks like, and we'll go head to head. So as we've learned, understanding earnings and sentiment is one thing, but spotting opportunity perhaps is another. So in this segment, we'll bring it to life, looking at where price and earnings are aligned, where they've diverged, and what that means, of course, for investors. So let's begin. Andrew Coleman is here, Sanjeev Narendran from Teaminvest. Okay, guys, so let's get to it because everybody likes talking about examples. So to bring it to life, what does it look like using companies when a market is behaving efficiently?
Yeah, absolutely. So if the market's behaving efficiently, what we would expect to see is that the share price of the company tracks the earnings. In other words, as earnings rise, the share price rises by the same percentage. When earnings fall, the share price falls by the same percentage. And most of the time, when I say most, 50 odd % of the time, but that's most, that's what happens in the market. And so some examples there that we can look at the moment, let's have a look at Visa from the United States. We'll pick a company that maybe not everyone covers here, but we know about. You can see, and I think we're going to show that on the screen, you can see that as over the last 10 years, Visa's earnings have expanded, the share price has moved pretty much in line. The dark blue of that chart is the earnings per share, and the light blue line is the share price at the end of each of those reporting periods. That's 10 years of data. Now, of course, you can construct that at home. What you just need to do is go to every annual report for Visa, grab the earnings, find the share price in the corresponding period and graph it. We're using our software because thankfully with automation, we've built to do that for us all the time so that we and our members don't have to keep trawling through annual reports. We're naturally lazy, but that's the concept, right? So Visa's a good example. An example from an Australian context is Mader Group. It's only been listed for about 6 years. Obviously a mining services, labor hire company. And as you can see, the same thing. There's earnings per share rising nice and steadily, and there's the share price tracking along with it. Now, that's an efficient market. It's what you would expect to see. And it says that owning a company like that, the return you're likely to get is simply equal to the growth in its earnings. If the earnings grow at 10% per year, you can expect a return of roughly 10% per year, right? Because the share price will track it. That's interesting and it's fun. And for a long-term investor, that compounding power can be worth a lot. But I think what's more exciting for today is to talk about the scenarios where the market isn't efficient. Because that's both where your big opportunities and risks come.
Okay, so inefficient to me would be earnings falling, share price not falling. Do we have any examples of that?
Yeah, well, that's the classic trap, isn't it, right? If you're an investor, the one you don't want to be in, probably more than anything else, is the business who is shrinking, but the share price masks it. It's kind of like the Titanic moving towards the iceberg, right? You know that eventually one day it's going to crash and sink. You just don't know when. And unless you can jump off into that lifeboat first, this could be catastrophic. So we'll give you a couple of examples from the past because I think it's easier to do that and then no one gets too offended. And then if I can be controversial, I'll give you 3 current examples where I think this is happening. That's dangerous. We'll see how that goes. So for example, from the past, let's have a look at Bapcor. Now, you and I on the call last year, we spoke about this before the big fall in Bapcor. But the fall in Bapcor, that 90% plus decline was entirely predictable if you just looked at that chart alone. That chart of earnings versus share price. Here you have earnings pretty much steady between 16 and 2022, 23. And then they fell off a cliff. Absolutely fell off a cliff as challenges started to appear. And yet for about 2-3 years there, look at that light blue line, it remained constant. In other words, the market kept convincing itself that things would turn. Bapcor would get back to the business it was. And only in the last few months, when people have finally realized that gone are the days of the old Bapcor, has the share price caught up with earnings. And look at that steep drop. That's that 80-90% wiping out of your capital.
So would you have been alerted to this instability right back there in 2023, 2024, when the earnings fell off a cliff? You would have, if you were hypothetically an investor in Bapcor, you would have got out then?
Yeah, well, I think Bapcor was never a business we were particularly excited about, but certainly from episodes of the call, Howard and I and Sanji and I think even Kevin as well, all called it out back, 2024, 2023, because for a value investor who understands that price in the end is earnings and sentiment can't stay high forever, you've got a very good leading indicator. If the earnings have fallen off the cliff, eventually the price will fall unless they can really turn it around. Now, if you're management, that's a problem. You've got to try and turn it around and fix it. If you're an investor, you can say, leave the hard work to management. Let's get out now while it's still worth quite a good price and put my capital to use somewhere else less risky.
So another one that comes to mind, and because it's been in the news lately as well, KMD. Now, I know you're driving Sanjeev there, but KMD, would we have seen, this is Kathmandu, would we have seen it in the earnings? Prior to sort of
catastrophe.
Now?
Yeah, KMD brands the old Kathmandu. If you pull that up, Sanji, and we go to the chart, I think you see it even a number of years ago in the case of KMD. I think it's 2020, 2021. There you go. You can see exactly that. The business between 2016 and pre-COVID looks like a wonderful rising earnings business. But for whatever reason, post-COVID, and I don't know the business well enough, it's not one we've covered for a very long time. By the way, for those following along at home, you can see if we cover it next to the word Intel, just above the graph, it's got a number. That tells you how many times we've written reports on it with our members. So in this case, 3 times.
Sorry to interrupt, but what about this to the right, this configure chart?
Oh, that's just our ability to add anything else we want to from the data. So I mentioned before, we're naturally lazy. The advantage of using computer systems that grab all this data that we've built over 20 years is we can effectively build a chart very quickly to look at any of these metrics. So today we're talking about earnings and price. We talked about return on equity or stability.
All right, we'll leave the right for now, but knowing that it can do other things. Good.
Absolutely. So if you look at the KMD Brands example, pre-COVID, this was a pretty efficient business from the market's point of view. You know, earnings growing nicely, well run, and price tracking it. But post 2019, the earnings fell off a cliff that never recovered, but the price took a hell of a lot longer to catch up, probably because there was that hope that things would turn around again. Now, of course, if you hold KMD today, you're down, 90-odd% from that peak. Maybe you wouldn't have got out exactly in 2020. You would have said COVID was a weird year. But as a value investor, by 2021, 2022, when it was clear that the earnings were not coming back, that chart was now a materially lower number than it had been before. The market was still able to offer you quite a reasonable get out of jail card. One hopes you took it.
Wherever you are in Australia or New Zealand, there are investors like you who are done going it alone. The best investors we know aren't just disciplined, they're connected. Teaminvest is an exclusive membership for long-term, self-directed investors who approach investing like business owners and compound their knowledge alongside 700 plus peers. Masterclasses held across 9 cities. Register your interest by clicking on the link in the caption.
Right. Okay, so you said current examples as well, which everybody at home will be writing this down, no pressure. But what's a current company that, earnings are falling, share price is not?
Yeah, well, I think there's 3 that I'll talk to, or we can talk to today. I'm sure they will all be slightly controversial. I expect you'll get people writing in about them and we'll have to answer future questions on them. But because when we're caught up in the moment and that market sentiment is driving our decisions, there's always a good reason to rationalize what's going on with earnings. That's the challenge, right? I mentioned it before about sitting still and doing nothing. Our challenge as an investor is usually when earnings drop, if we like the business, we find an excuse. If we don't like the business, it's fine. We just say, well, badly done. But if we like the business, we excuse it. The problem is that excuse hurts us. So here's 3 examples where I think the market is massively excusing that. The first one I'll give you is Tesla. Nice and controversial. I said they would be. So Tesla in the US, if we can just pull up Tesla's chart, you'll see exactly what I mean here. So here's Tesla. Between sort of 2016 and 2023, Elon Musk was obviously quite well regarded by people, rightly or wrongly, but at least the earnings of Tesla were moving in an upward direction, from loss-making into quite meaningful profits in dollar terms, never in terms of share price, but in dollar terms. And the share price roughly tracked that. If you have a look at sort of, flat and low when the earnings were negative, spikes around the promise of the future. But have a look what's happened since 2023. Despite growing and taking over the world and becoming a tech company and then a robot company and now an AI company, Tesla's earnings have dropped by probably 60% looking at that chart. And yet the share price is now still as high or close to as high as it's ever been. That cannot remain forever. That means sentiment, the way we're justifying it, is far outpacing the trend in earnings. And one of 2 things is going to happen. Either Elon's going to get it right and the earnings are going to suddenly shoot back up. I doubt that, but it could happen. Or the market's going to wake up, sentiment is going to shift, and the share price is going to fall probably to the top of that blue bar, if you have a look at sort of naturally how it tracks, which would put it down 70-odd% from where it is today, if that's around sort of 350 down to about 100.
You're right. So what about a local example? Sorry, but I will ask.
Yeah, well, I think there's 2 in the local market if you want to call out. The one is BlueScope, BSL, Scope Steel, obviously subject to a takeover bid at the moment, and that's partly what's keeping the share price up. But if the share price isn't sustained by the takeover, in other words, the takeover falls away, have a look at that from an earnings chart versus a price chart. Here is a price that has steadily risen for about 10 years. Meanwhile, earnings today are barely larger than they were 10 years ago. That's sentiment shifting. Now, partly that's justified. Pre-COVID, we didn't believe as much in supply chains. Steel was considered old world. But subject to Seven Group's takeover not going ahead, in an efficient market, that light blue line is going to come crashing down to the dark blue column.
So this could be a potential, as you call it, get out of jail free
Right now.
point in time.
Absolutely.
Yeah.
And I think if you stay in it and the transaction doesn't go ahead, it's a walking capital killer.
Yeah. Okay.
Another example is NextDC. We mentioned it before.
Yeah.
Obviously in a difficult to predict sector, so there's no reflection on NextDC's management. But it's another example of a company whose earnings and price have diverged materially. Have a look at that. Losses have remained large. Now, that's because they've got their big data center rollout, I understand. Meanwhile, the share price not only has gone higher, but has remained higher as losses have expanded. Again, like with Tesla, like with BlueScope, either those earnings have to come back suddenly or the share price is going to fall when sentiment shifts. Now, I don't know when sentiment will shift on data centers. I certainly couldn't predict the time, but you know that if one day the market gets efficient and that earnings and price catch up, that's got a long way to fall from here.
Okay. So then we talk another scenario. So these categories, earnings rising, Sanjeev, price is not. So is this, in your view, where the real opportunity lies?
Well, it sounds about right? If the earnings keep going up, but the rest of the market hasn't caught on yet,
So
then
the sentiment has not caught on.
that's right. The markets just ignore these companies, but the companies continue to build up and do well. That's potentially a great opportunity.
So past examples.
Well, I'll just say first, that's exactly what you're hoping for as a value investor, isn't it, right? The market is not correctly valuing the wonderful growth that the business is delivering. Now, we'll do it again the same way if I can to avoid being too controversial too soon. Let's have a look at some companies where that was happening in the past.
Okay.
So earnings were rising, share price didn't catch up, and you'll of course see the eventual catch up. And then we'll talk of, I think, 4 examples today where I think that's occurring and are potentially good investments for that reason. In fact, I own all 4, so clearly I think they're a good investment. So Smart Group, of course, is the salary packaging provider. And for whatever reason, in that period up until sort of 2022, 23, if you have a look at that, the earnings were rising gradually and pretty steadily so. That's a sort of slight upward trend in earnings. And yet look at the share price from 2017 down to 2022. It had almost halved.
Yeah.
No surprise what's happened. Earnings have continued to grow. That's a little faster recently, but generally continued to grow. And that very low share price of 2022 bounced back quickly and has now made a very good return to any long-term shareholder who was prepared to accept that sentiment eventually shifts. Another example for a long time was Technology One. I'm going to use it as an example later of where the market perhaps has got too exuberant now. But between 2016 and 2022...
That all matches quite nicely, doesn't it?
Well, except have a look at between 2016 and 2022, right? That light blue line is well below the dark blue. Now it's growing. Sure, the share price was rising, but the earnings were growing much, much faster than the share price. And so it's no surprise that come 23, 24, and then to 25, there was a big catch up. The market share price rose dramatically. I think it sort of went up 3-4 times in a period of only about a year and a half. Because in theory, that light blue and dark blue should move exactly so they're together, right? The light blue and the dark blue should be touching. They now touched in 2025, but they certainly didn't for a long time beforehand. Pro Medicus, another one that's had a huge run recently, well, now down a bit, but for a while was a huge run. But again, you could see that not in the most recent year, but between 21 and 23. Have a look at what happened in the earnings between 2021 and 2023, 24, 25. So between 2021 and 23, the dark blue shot up much faster than the light blue. Then the light blue went through the roof, and now it's just coming back down to be more reality. And Codan's another example of one where you saw this happening.
Yeah, and these ones are also, companies that have come under a lot of pressure lately. So that's that mean reversion. Right?
Absolutely. So have a look at Codan. For a long time there, the dark blue earnings are far outstripping the light blue price. Now they've caught up. The question you've got to ask as a Codan shareholder is, have they gone too far? That's another topic we can talk about later. But you expect to see that over time. Eventually, given enough time, the market isn't made up of idiots. At least one hopes it isn't. I mean, it's all of us, right? Professional investors, retail investors, wholesale investors. We're going to be doing our digging. It just sometimes takes us a while to notice that there's this discrepancy between earnings and price. Now, if you want, I can be controversial and give you a couple of examples.
Like that. Thank you.
So here's 4 examples that I think, and Sanj, you can pull them up just one after the other quickly, of where you're seeing that same thing that we saw in those companies in the past happening right now. Earnings growing faster than share price, and you would expect in the next few years share price to catch up. So as you can see with Jumbo, look at that earnings chart, steadily rising all the way through that period. For a while there, price went above earnings. The market got euphoric. Now price is well below earnings. Have a look between 2024 and today. That TTM stands for trailing 12 months. In other words, the most recent one. Earnings have risen materially from where they were back in, say, 2019, and yet the share price is about half. That blue line, the light blue line, has diverged materially from the dark blue bar. That's going to catch up at some point. Another example, and I know it's been spoken about ad nauseum, but is CSL. Ignoring all the noise about the CSL, and there's lots of other reasons to talk about it, have a look at that. For a long time, CSL was a market darling. The light blue was well above the dark blue. In other words, the market was rewarding with sentiment more than the company was doing in earnings. The pendulum has swung. So share price has dropped materially, down 60%. Meanwhile, the earnings are pretty much the highest they've ever been. Now, should they have ever justified the old price? Different story. You can see the light blue very far above the dark blue. Probably this was an example of one where the market got exuberant. But right now, that's an obvious divergence. And then data 3 is another one, DTL. Same kind of example. These will all look the same, right? Nice rising earnings, falling share price. And finally, Clinuvel, CUV. All in different sectors. Obviously, data 3, of course, IT, hardware, and software distribution. Clinuvel,
An
bio.
interesting one, yeah.
Yeah, look at that. There's a company who steadily increased its earnings year on year. Meanwhile, market got euphoric for a while. Now the share price is about a third of what it was when the market was euphoric, but earnings compared to the same period are more than double.
Yeah. All right. So let's get to scenario number 4. And that is potentially what we could call the growth trap or the value trap, where we're seeing both share price rising, earnings rising, but, you know, it is possible for sentiment to just get too exuberant, right?
Yeah, absolutely. I mean, the challenge to some extent, we mentioned it before, right? There's 2 big risks when you're a value investor, because looking at that chart's easy, right? Like it should be really simple to look at this and make most of the time a really good decision. I mean, there'll be odd one you get wrong, but it's hard to make big errors. So why is it that humans make errors all the time, right? It's because our biases come in. So we do 2 things. The one category, and we spoke about them already, is we justify the dropped earnings and pretend it's a one-off.
Yep.
So we don't actually act soon enough. The other one is when there's a business we love who is performing, and it stops being the case that we love it by ourselves and starts being the case that everyone loves it, sentiment overshoots. And therefore what you see is you see price and earnings rising. That gives you a nice bit of comfort. But that line, the light blue line, rising much faster than the dark blue. We mentioned CSL before.
Yeah.
And those are the ones which are probably in many ways the most dangerous for a Teaminvest or Buffett style investor. Because hopefully you're disciplined enough to avoid the ones where earnings have fallen. The mistake is asking yourself in these scenarios, should I be getting out or not?
So the one that we referenced earlier that comes to mind first is Pro Medicus.
Absolutely.
So can we bring that up again, if you don't mind, Sanjeev? Because
Sure.
this kind of comes down to timing, right? Just buying at the wrong time. So you have to maintain your discipline to not overpay for a company, even if you love it, right?
Absolutely. I mean, look, Pro Medicus is, we've said this before, but I think I'm not alone in saying it's probably one of the top 10 companies on the ASX, if not the top 5, in terms of the business itself. Now, whether it will remain that way forever, who knows, right? And certainly from a Teaminvest point of view, we've covered it from a very long time. You can see there 25 under the intelligence, and we do that roughly once or twice a year. So that shows you how long we've been covering this company for, sort of well over a decade. The challenge is that the market suddenly woke up to just how good Pro Medicus was in roughly the end of 2023. You can see that on the chart, can't you? The light blue line suddenly shooting up well beyond where the dark blue bar was. And it actually got to the point where Pro Medicus was trading on a PE of over 300 times. Now, we said the market long-term average is 20 times, right? So from that point of view, how do you maintain the discipline to say, this is a wonderful business, I love it, but if you're going to be offering to buy it from me for 15 times the long-term likely average, it's better off in your pocket than mine. Obviously, if you can look at charts like this and you have that discipline, which I would hope at Teaminvest we do, that's a great opportunity to get out before the crash and maybe buy back in when it swings the other way. but it's difficult.
'Cause
That's
you
the
reckon-
human element.
But then this is the thing. You reckon that there will always be a time when there's a reckoning when it comes to over-exuberance.
Absolutely. I mentioned it the other day with you, but, in fact, it was a viewer question said, how do you at Teaminvest handle missing out on an opportunity? And I said, wait 18 months. Because roughly it's every 18 months that this cycle changes. And so in the same way as Pro Medicus and TNE were market darlings 18 months ago, and WiseTech was another one, I didn't agree with that, but it's a different story. They have come back down to earth. They have to. Icarus can't keep flying too close to the sun before their wings melt.
So it doesn't mean they're bad companies. When you see that share price crash, you've got to stick to your knittings and do the work.
And when it rises, get out. Be thankful that Mr. Market is offering you a PE that makes no sense. If you think the long-term average PE is 20 times, if the market offers you more than 40 times earnings for a company, it's almost certainly that the market is being foolish. It's been caught up in its own groupthink and hype. Now, maybe you could hold on a little longer and get 50 times or 60 times or 70 times. But why take the risk? Why not take it out at, say, 40 or 50 times and buy one of these other companies whose earnings are rising, the market sentiment is falling, and you've got the opportunity of buying them at, say, 10 times earnings and making far more money in the long run.
And then just repeating what you did before, right?
Rinse and repeat. Okay, so we've got these 4 categories that you need to be cognizant of, and I think we're going to bring them up on the screen. So we've got, what it should look like if the market is efficient. You're looking for warning signs of serious danger. What are those?
Well, the warning sign of serious danger really is where the earnings have fallen and the share price hasn't. I would argue just earnings falling is the sign of serious danger. But for the investor, as opposed to the management team, it doesn't matter if earnings are falling and you're not in it. What matters is if earnings are falling, you own it, and you are lulled into a false sense of security by a stable share price.
And the neon lights of a potential bargain,
Well,
hard to resist.
Yeah, well, that's what we talked about, right? Earnings are rising much faster than share price. You see that by represented by that dark blue bar and light blue bar diverging, or simply the PE ratio. If the PE ratio is sort of under 12 or 15 times, almost certainly it means the market's valuing it wrongly.
Got it. And so great discussion, guys. And you're sticking around to answer a viewer question. Really great to have a look at that conscious investor technology. And perhaps if you ask in the future, we can do that a little bit more. And speaking of asking, let's get to your viewer question. Yeah, just a reminder that you can send us questions to wealthy@ausbiz.com.au. And if you have any specific requests for Andrew or for Sanjay, again, we're very happy to try to accommodate. And this next question, I have to admit, came from a viewer, and I have paraphrased it a bit, but this kind of gets to the heart of it. It's for Sean. He says, we're in our early 60s. We want to start investing to grow our nest egg. And actually, they said eventually buy a home. Where should we start? Look, I thought that this was a good question, guys. Correct me if I'm wrong, just because all of this stuff sort of makes sense in theory. It makes a lot of common sense at times, but I think that it can be daunting for people to figure out, where do you start? Do you just go out and buy one CSL share, one TNE share, one PME share? So what's your answer?
It's a really tough question, right? Particularly if it's not something that you've done a lot of. But what I would say is start where you should always start, which is with education. I don't think it's possible to do anything well if you're flying by the seat of your pants and guessing. So start with education. That means watching AusBiz. It means reading about things, maybe using AI to help you with tips, maybe coming along and becoming a Teaminvest member if that's what interests you. But learn first before you put your capital at risk. I mean, at the end of the day, your goal here is going to be to compound your wealth the fastest you can without taking risk. And the biggest risk you're going to have is making an investment you don't understand, whether that's because your financial advisor suggested it was a good idea and you did it without thinking, whether it's because you got a tip at a barbecue, whether it's because you watched the call and something looked good. At the end of the day, we are parted with our hard-earned capital most commonly because we take a risk we don't understand than we are because we just got it wrong. So start with education. There are groups that do that. The ASA is a good spot. Obviously, there's AusVids. There's us as well if you're wanting a much deeper education. But that's really where to start. And Sanjay, I think you run this part of the business for us, so it's worth talking about.
Well, that's really it. I mean, what we do at Teaminvest is all about education. It's all research and data driven. So you start with the education, start with the research, but don't bite off more than you can chew. What we do at Teaminvest is also about knocking out things. So if you see a strategy or an approach or something, it doesn't fit in your wheelhouse, knock it out. and then focus on things that you do understand. Things that are simple to understand, because in most times, and in my career in the broking industry, things are presented way more complicated than they need to be. Really, the fundamentals are simple, and you can just follow simple things that can be understood by anybody, and you'll be able to do that and do that really well. And that's how you're going to build up your nest egg.
Yeah. So start small, and keep in mind that this is also information and not financial advice for your own personal circumstances. You really do need to do your own research or get advice if you need it.
Absolutely. And I think the other thing to say is we make the mistake as humans of wanting to dive right into anything we do. It's just a part of our human nature. Don't do that if you're new to investing. Bite off little bits at a time. So do the education first and then buy one thing, maybe an index fund, a managed fund, one share that you really like, and then add to it slowly. Same thing if you've got an existing portfolio that you've inherited. Don't change it overnight. Find the very worst one, the one you like least, maybe the one that's the most obvious dog dressed up as a unicorn, and get out of it and just spread the capital into something else, because the rush of getting out or getting in is almost always a recipe for getting caught up in the market mania and blowing up your capital.
Wonderful, guys. Thank you, Sanjeev Narendran from Teaminvest, Andrew Coleman also from Teaminvest. That was a great episode. Look forward to seeing you both next week if it pans out that way. Thanks for watching Wealthy and Wise. I think we've learned while you can't predict sentiment, you can profit when it's wrong. See you next week.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.